Hi, everyone. I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our November 2025 update on the IM Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. A friendly reminder as we close in on the end of the year, DBMF will be going ex-dividend on December 30th with a payable date of December 31st. So if you're considering implementing DBMF this year into taxable accounts, tax loss harvesting, etc., you may want to wait until on or after 12/30 to do that. We don't want any unexpected tax implications for new clients. On the screen, you can see here the website address where you can pull down that distribution data, as well as a reiteration of the tax loss carry forward numbers we talked about in last month's update. None of this is tax advice, of course, it's just information. Okay, on to recent performance, positioning, and more color on the markets and landscape. Over to you, Andrew.
Thanks, Mike. Well, it's starting to feel a bit like an everything bubble. Equities are obviously expensive and bond spreads are razor thin, none of which has prevented a terrific year for both asset classes. We've had plenty of scares this year, but the economic world has remained remarkably stable. No collapse in AI spending, no tariff-induced recession or runaway inflation, no contagious bond market tantrums. The tricky part for allocators is how to hedge today. The gold trade's best days are most likely in the rearview mirror. Bitcoin behaves suspiciously like a leveraged bet on Nasdaq. Previously unloved foreign markets have soared, so it's not obvious where the next dollar of capital should go to diversify traditional assets. Of course, our answer to that is to use commodity trading advisors, where nimbleness means you can participate in a year like 2025 and yet reposition if necessary for a very different 2026 or 2027. Hence, I'd argue that CTAs are particularly well suited as a diversifier today, given the scarcity of obvious alternatives. On the performance front, to pivot to the left side of the page, DBMF was up around 2% last month and is now up nearly 13% year to date, dramatically outperforming both the SocGen CTA index, which still is down this year, and the Morningstar systematic trend category, which is up a few percent. A very generalized lesson this year appears to be that the more complex the CTA strategy, the worse performance has been. With that, let's hop on to the year-to-date line chart. We're now up 12.71% this year on an NAV basis and are outperforming the SocGen CTA index by over 1,400 basis points and the Morningstar category by over 1,000 basis points. The first thing to note is that we are confident that we are accurately picking up on the CTA signal, meaning directional trends. Instead, the strong outperformance is due to four factors that have all played in our favor this year. More sensitive risk controls and shorter-term models were head faked badly by Trump after Liberation Day, and by de-risking too quickly cost alpha. Second, liquidity dried up in non-core markets, and hence de-risking and repositioning was more costly than normal. In other words, slippage has risen in more complicated models. Third, our concentration in major markets, and I'll show you the yen move shortly, has helped us more than hurt us. And lastly, there's an element of luck around the timing of rebalancings, a natural feature of any portfolio. So to summarize, alpha in the CTA space can be negative, and we believe that the embrace of more and more complexity in the space has cost investors a lot more in risk-adjusted returns this year. Here's our inception to date performance from 2019. In part because of such strong performance this year, we've now added more than well more than 300 basis points of returns relative to the SocGen CTA index, with more than double the Sharpe ratio and a correlation approaching zero point 0.9. As discussed last month, a very interesting question is whether the expected outperformance relative to hedge funds, represented by the SocGen CTA index, should be higher going forward. We believe the reason is not necessarily hedge fund fees, but rather implementation costs. A decade ago, we assumed that trading efficiency might add another 200 basis points to our net returns relative to hedge funds. Today, though, with the proliferation of more and more complicated portfolios, that estimate looks low, unless, of course, more positions and more trading start to generate enough value to cover those higher implementation costs. While the recent data is not encouraging for hedge funds, it really will take a few years of live performance to validate such a conclusion. As noted last month, regardless, we're thrilled that it's been working better through the difficult periods of 2024 and this year. Here's our slide on volatility adjusted positioning. The green bars are the volatility adjusted exposures of our 10 futures contracts at the end of November, and the red dots are as of the end of September. Moving from left to right, in commodities, we were long oil at the end of Q3 and are now short, but we remain long gold. In currencies, we've maintained roughly the same sizable short yen, long dollar position, while being modestly long the euro. In bonds, we're long across the board with the belief that rates will not rise from here, and we've pulled back on equity risk with a long bias toward emerging markets. So while the overall positioning is continuation of the market-wide run-it-hot trade, which CTA spotted early on, we have de-risked a bit since the end of Q3. Here's contribution for November. Gold continues to add to performance, but the big winner again this month was the short yen trade. Last month, we talked about one of the powerful features of the strategy is its limited memory. This month highlights another powerful feature of that strategy in that it can be unemotional. It can be very contrarian. So while the BOJ apparently is in the process of normalizing its monetary policy by signaling it will raise interest rates, which the Fed and ECB are cutting, the expectation was that the yen would appreciate. But the yen has continued to weaken, the opposite of consensus. If and when the yen does change directions, the models will adapt. So, CTAs look for evidence in markets beyond just conjecture. Now, moving across the rest of the portfolio, we picked up a bit of performance in oil, rates, and the euro while losing some in equities. And with that, I'll pass the baton back to Mike.
Okay, thanks, Andrew. So let's wrap up here with long-term performance numbers for DBMF. Annualized return since inception, including the month that was November 2025, is now 8.19%. That's ahead of the SocGen CTA index by 390 basis points annualized, and it's ahead of the Morningstar systematic trend category average by over 485 basis points. And long-term performance against the traditional diversifier for equities, that being bonds as represented by the Bloomberg Ag, is well intact, DBMF outperforming by 655 basis points annualized. So thanks to our clients and our prospective clients for your confidence and your interest in DBMF. If you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.